As interest rates climb across the globe, we're edging toward an economic squall that feels all too familiar, yet carries unprecedented implications for our times. In this video, we'll unravel the complexities behind the bond market's collapse, uncover the critical significance of bonds for investors and economies alike, and assess how this turmoil could impact you. Alarming headlines like U.S. 10-year Treasury yield hits 5% for the first time. Since 2007, inches have been circulating, stirring unease in financial circles. Contrary to initial impressions, the surge in yields signals not a boon, but a brewing storm in the financial forecast. Investors who placed their faith in the safe havens of U.S. Treasury bonds are now witnessing their portfolios plummeting at an alarming rate. To grasp the fallout and implications of this scenario, a solid understanding of how bonds operate is essential. Let's dive together into the intricate world of finance and peel back what's really happening behind the figures and headlines. Brace yourself for an in-depth analysis that promises to shed light on the dark corners of the bond market and its ripple effects across the global economy.
Underestimating the potential weakness in bond markets.
U.S. Treasury bonds are a pretty safe investment.
Unless you have to go and sell the bonds.
The Treasury increased interest rates, and when interest rates rise, bond prices fall.
When rates move the wrong way, losses can mount in a hurry.
Imagine stepping into a realm where each financial move unfolds with predictable precision, much like a meticulously scripted play. This is the world of bonds, where certainty reigns supreme, and every detail of the transaction is etched in ink upon the bond itself. Envision a 10-year bond from the Treasury with a 2% coupon, a promise of an annual return inked onto the very fibers of the bond, alongside the assurance of a return principal at the decade's end. However, the plot thickens in the bond market's grand theater when these financial instruments are exchanged not just at face value, but on the open market's dynamic stage. Here, prices ebb and flow with the rhythm of interest rates, and the act of holding a bond to maturity becomes a tale of choice rather than necessity. Cast your mind back to 2020, an era of virtually non-existent interest rates, a time when purchasing bonds was akin to entrusting the Treasury with your funds for a minuscule yearly return. Fast forward to the present, where rates have climbed with relentless determination, compelling the Treasury to issue new bonds with a far more alluring 5% coupon, a stark contrast to the humble offerings of yesteryears. As this narrative unfolds, an inescapable truth emerges. The value of older bonds withers under the scorching spotlight of rising rates. The bond market script now demands a discount for these seasoned actors, aligning their market value with the enticing yields of their newer counterparts. The graph of 10-year U.S. Treasury bond yields mirrors this dramatic saga, rising in tandem with interest rates. Yet when the curtain is pulled back on bond ETFs holding these very bonds, a different scene is revealed. Their share prices have plummeted, echoing the fate of the bonds they harbor. This unfolding drama paints a stark picture. A bond ETF's value halves since its zenith in 2020. Such a decline is a familiar narrative in the volatile realms of crypto or even the stock market. But in the steadfast domain of bonds, known for their reliability and safety, a 50% plunge is a plot twist of epic proportions, leaving even the most stoic of investors with a sense of unease. It's a reminder that even the safest havens can experience upheavals, turning the bond market into an unexpected thriller, full of suspense and uncertainty. This steep fall in bond ETFs is a harbinger of change, signaling a fundamental shift in the landscape of investment. It's a financial paradox where the instruments designed for stability become the harbingers of a potential crisis. The once calm waters of the bond market are now troubled, and the ripples are felt far and wide, challenging the norms we've come to trust. As the story of the bond market continues to unfold, Investors watch with bated breath, wondering what the next act will bring in this unexpected drama of financial markets. As we steer through the choppy waters of rising interest rates, investors clutch their bonds, watching their market value diminish like sand slipping through their fingers. The dilemma is stark, a paradox of significant paper losses versus the potential for recovery. Picture the investor from 2020, now beholding a portfolio that's a mere shadow of its former self, with values plunging to a harrowing 50 cents on the dollar, a scenario that sends shivers down the spine of even the most seasoned bondholders. Bank of America has dubbed this dramatic saga the greatest bear market of all time in the bond arena. Yet, within this financial maelstrom lies a quiet eye of the storm, where the turmoil is both a significant concern and a non-issue. It's a tale of two outcomes, hinged on a simple question: to sell or not to sell. Bonds, those beacons of predictability, offer a solemn promise. Hold on to them until their maturity, and they will deliver the agreed-upon returns, unscathed by the market's whims. The collapse of market value is but a specter for those who can endure until the bond's denouement. Yet, this paper loss is not to be dismissed lightly, for it carries the weight of potential real-term losses to the relentless march of inflation. Investors now stand at a crossroads, balancing the need for liquidity against the potential for full recovery. Those who can weather the storm until the bond's maturity will emerge unscathed, their investment intact. But for others, the current climate is a reminder that even the safest harbors can be rocked by financial tempests. As we navigate these tumultuous seas, the true test will be whether investors can hold their course or if the siren call of market pressures will lead them astray. In the unfolding drama of the bond market's upheaval, not all actors can remain steadfast until the final curtain. It's a financial crisis in the making for those compelled by necessity to liquidate their bonds prematurely, a scenario that reverberates with echoes of the recent banking turmoil, a tempest that may yet see its second act. Consider the plight of Silicon Valley Bank, ensnared by a balance sheet heavy with bonds from more prosperous times. As the tide turned and the startups it nurtured began to falter, a cascade of withdrawals ensued, forcing the bank to sell its bonds at a pittance, incurring colossal losses. This cycle of fear, catalyzed by their financial disclosures, snowballed into a full-blown bank run, leading to an implosion that sent shockwaves across the financial sector. While the dust has settled somewhat, the undercurrents of concern for smaller banking institutions persist. The key to their survival hinges on their ability to stay the course with their bond holdings, avoiding the need for distress sales that could crystallize their paper losses into financial avalanches. Most banks, particularly the larger ones, are anchored by sufficient reserves to weather the storm without resorting to fire sales. Yet, they are not without their woes. The irony of their predicament is that they have anchored their wealth in the bonds of yesteryear, at a time when interest was but a trickle. Now, as the bond yields burgeon to 5%, these institutions watch from the sidelines, their coffers bound to the past, unable to seize the lucrative opportunities of the present. Thus unfolds the story of the bond market, a tale of caution, endurance, and the consequences of timing in the intricate dance of finance. In the labyrinthine world of finance, the inverted yield curve emerges as an enigmatic sign, a harbinger that defies conventional wisdom. The yield curve, typically ascending as bond maturities lengthen, has twisted into an inversion, creating a peculiar situation where short-term bonds shine brighter than their long-term counterparts. This financial anomaly has not gone unnoticed, as investors, with a keen eye on the Federal Reserve's steadfast resolve to maintain high interest rates, opt for the immediate gratification of short-term bonds. The allure of higher yields beckons, offering a strategy to outmaneuver the long game by exploiting the generous returns of the present. But this inversion is more than a quirk. It's a signal, a shift in the market's undercurrents as the yield curve begins its journey back to a state of normalcy, pushing long-term Treasury yields to peaks unseen since the pre-recession days of 2007. As the economic tides turn, the labor market's resilience and the resurgence of inflation whisper promises of a protracted period of elevated rates. The plot thickens for bond investors as the narrative of this financial saga unfolds. Long-term bonds, once the stalwarts of portfolios, now find themselves abandoned, their yields climbing as investors recalibrate their strategies. The siren call of short-term bonds with their attractive yields beckons, tempting investors to forsake the long haul for the lucrative turnover of the present. In this theater of bonds, the inverted yield curve plays the leading role, with investors as the captive audience. While the headlines might herald a time of opportunity, those entrenched in bonds face a dire predicament, a financial meltdown that threatens to unravel the tapestries of their carefully woven investments. For those who cannot endure until maturity, the weight of potential losses looms large, a specter over the realm of fixed income investments. As we draw the curtains on this episode, we invite your engagement. Hit the like button if you've been enlightened, subscribe for a continued journey into the depths of economic intrigue, and prepare for the next installment where the enigmas of finance unravel further. Until then, we bid you farewell from the stage of the bond market's greatest drama.